Investors' February's close brings a market dip, priming March for buys. Despite a pullback from its early peak, the uptrend holds. The 150-day moving average, where institutions and long-term players anchor, stands firm, signaling strength and hinting at a buy. It aligns with November's election and a Trump resilience zone. A break below spells trouble. Otherwise, expect consolidation or a spring surge to highs. This isn't a red flag, it's a green light for sharp capital moves. Stock number 1, Shopify. Shopify emerges as a standout for March, crowned the most upgraded stock of February post Q4 earnings per market beat data. The numbers dazzle. Q4 2024 revenue soared 31% to $2.81 billion. Gross merchandise volume, GMV, jumped 24% to $82.3 billion, and free cash flow hit 22% margins, crushing expectations. Analysts 40 track by Zacks hoisted targets to a $130 median, up from $110, fueled by robust guidance projecting Q1 2025 revenue growth in the mid-20s. At $11.2 billion annualized run rate, Shopify's capital return engine revs up, with $1.5 billion in buybacks planned for 2025. The e-commerce titan thrives at the crossroads of consumer hunger for online access and merchants' AI-driven push, deepening penetration with tools like Agentforce 2.0 and Shop Pay, up 50% year-over-year to $27 billion GMV. A client base spanning 2 million-plus merchants across 175 countries cushions it against sector wobbles, cementing hypergrowth staying power. Economic headwinds, like February's Consumer Sentiment Index dipping to 74.3 Michigan, barely dent the thesis. Shoppers aren't retreating, they're pivoting to value-driven buys over big-ticket splurges, a shift Shopify's broad retailer mix absorbs effortlessly. Technicals back to play. After peaking at $146.87 post-earnings, Shop eased to $129.50, a 12% pullback, finding support near $125, aligning with the 50-day moving average. This dip reflects profit-taking, not panic, with the uptrend intact since June 2024's $63 base. Sideways action or slight retreat to $120 could precede a thrust past $140 by June, riding tailwinds like a $1 trillion U.S. e-commerce market, Statista, and Shopify's 12% slice. For portfolios chasing growth with resilience, this dip is a launchpad, not a ledge. Stock number 2, Salesforce. Salesforce just dropped a solid Q4 FY25 earnings report. $9.99 billion in revenue, up 7.6% year-over-year, with net income soaring 18% to $1.71 billion, yet the stock took a hit, dipping 6% after hours on cautious guidance. Analysts aren't sweating it, they see this as prudent restraint, not weakness. The company's not chasing reckless growth like some overhyped EV flops. It's scaling its AI-driven Agentforce platform deliberately, backed by $1.78 billion in free cash flow, up 30% year-over-year. That cash is fueling hefty capital returns, with $1.6 billion returned to shareholders last quarter alone via buybacks and dividends. Posts on X and analyst notes from Morgan Stanley and Wedbush highlight Agentforce potential to reignite double-digit growth by FY26, projecting 10% revenue gains as AI adoption accelerates. This isn't a hype train derailing, it's a titan playing the long game. The chart tells a CAGR tale. CRM slipped below the 150-day moving average, hovering around $290 after a post-earnings skid from $347.10. Oversold signals are flashing, with support firming up near $285 to $290, unlikely to crater much lower. Bulls eye a swing back to resistance at $315, then $325 if momentum holds. Analysts remain upbeat, trimming targets but clustering around a $375 to $400 consensus, per Zacks and TipRanks, signaling 15 to 20% upside from today's levels. That aligns with a market poised to reward Salesforce's disciplined execution and AI upside, making it a compelling March pick for those betting on a rebound. Stock number 3, SoundHound. SoundHound AI rode the AI tidal wave in 2024, skyrocketing 835% as NVIDIA's $3.7 million stake, revealed in February, supercharged sentiment. That euphoria crashed in 2025 when Nvidia dumped its 1.73 million shares, sparking a 28% plunge on February 14th and a brutal 45% year-to-date drop, per recent web data. Investors balked. Why would Nvidia bail? Look closer. Nvidia's exit netted over 100% gains in under a year, a savvy cash out after a 5x Q4 run-up. Fundamentals haven't budged. Q4 2024 revenue doubled to $34.5 million, beating estimates, and FY25 guidance rose to $157 to $177 million, a 97% leap at the midpoint. Wedbush's Dan Ives, a vocal bull, doubled his target to $22, calling SoundHound an underappreciated AI pure play poised to dominate voice tech. At $12.91 today, down from December's $24 peak, this dip screams opportunity for those who see beyond the noise. Volatility is no surprise here. This startup-esque tech gem isn't profitable, yet bleeding $92 million through Q3 2024, with short interest at 23.5% of float, fueling wild swings. February's 53% slide stung high-entry buyers, but the long game looks compelling. A $1 billion order backlog, partnerships with Stellantis and Chipotle, and a voice AI market projected at $140 billion by decade's end anchor the bull case. Analysts 6track by Zacks hold up by consensus with a $13.25 average target, though Ives sees $22 and H.C. Wainwright $26. Cash reserves near $200 million post Q4 debt-free by the runway to profitability by 2026. Short-term traders might flinch, but for patient capital, this pullback below 30x 2025 sales versus 74x peak offers a rare entry into a hypergrowth story, perfect for March portfolios betting on AI's next leg up. Stock number 4, Nvidia. Investors, Nvidia stands out as a prime March target following its latest earnings triumph, a beat-and-raise quarter that underscores its dominance in the AI and tech arenas. The stock has pulled back post-release, a recurring pattern that savvy market players recognize as a buying window. Analysts are buzzing, lifting price targets toward uncharted highs, with the automotive segment stealing the spotlight. Though still a modest portion of Nvidia's revenue, this division's growth, up 103% year-over-year to $570 million in Q4 2025, per recent reports, signals a breakout. Driven by robotics, driver assist systems, and autonomous vehicles, it's on track to become the next billion-dollar pillar. Historical trends back this up. Despite initial dips after strong reports, the stock typically rebounds within weeks, making early March a strategic entry point as speculative froth unwinds. The broader narrative bolsters Nvidia's appeal. Partnerships with heavyweights like Toyota, Uber, and Hyundai, announced at CES 2025, cement its role as the backbone of self-driving tech. The Drive Hyperion platform, now safety certified, and the Cosmos AI suite are accelerating autonomous innovation, positioning Nvidia to capture a slice of a market McKinsey pegs at $400 billion by 2035. Meanwhile, the data center segment, fueled by AI demand, grew 93% in Q4 per Yahoo Finance, with Blackwell chip supply constraints only amplifying anticipation for future quarters. Yes, expectations are sky-high, often sparking post-earnings volatility, but the fundamentals, $39.3 billion in Q4 revenue and $5 billion automotive run rate forecast for 2025, scream resilience. For those with a stomach for the ride, Nvidia's dip is less a warning and more a launchpad. Stock number 5, 3M. Investors, 3M's journey has been a roller coaster, but the ride's turning upward. Once a dividend king with 64 years of payout hikes, it slashed its dividend by 50% in 2024 from $1.51 to 70 cents quarterly, post the Solventum spinoff, and amid legal storms like the $10.3 billion PFAS settlement and $6 billion combat arms earplug resolution. Those headwinds are now tailwinds. Q4 2024 sales hit $6 billion, up 0.1% year-over-year. Organic growth clocked 2.1%, and adjusted EPS rose 21% to $2.39, smashing estimates. New CEO Bill Brown's cost-cutting and innovation focus, detailed at the February 26th Investor Day, projects 6 to 8% EPS growth through 2027, with $10 billion in shareholder returns via buybacks and dividends by then. The stocks soar 94% over the past year, yet at $152.20, 13x 2025 EPS of $11.70, it's still a bargain compared to its pre-crisis $200 plus peak. March could see this momentum accelerate as sentiment catches up to the fundamentals. Technicals scream opportunity. After dipping below $90 in mid-2023, MMM's reclaimed its 150-day moving average, with support solid at $145 and resistance looming near $160 to $165. Analysts 19 tracked by Market Screener peg a $154.30 median target, but upside could stretch higher if March catalysts, like legal closure or guidance reaffirmation, ignite. The dividend cut, less severe than feared, has reset the payout ratio to a sustainable 40% of free cash flow for $0.5 billion projected for 2025, freeing capital for growth and reinstating raises, $0.73 due March 12. Pre-legal woes, 3M traded at 16x earnings. Today's discount reflects a sentiment lag, not a business flaw. For those hunting value with a growth kicker, this former king's reclaiming its crown. March might just be the coronation. Conclusion. Investors' March beckons. A dip primes the hunt, with the 150-day average signaling strength for a spring surge. From AI to e-commerce, value to voice tech, opportunities gleam. The FOMC's March 19th to 20th looms, PCE at 2.4% hints at summer rate shifts, igniting markets if dovish. This isn't a lull, it's a well-fuse. For continued insights, consider subscribing to the channel. Access is just a click below, delivering in-depth reports, actionable recommendations, and expert perspectives. This community is built on discipline, strategy, and precise execution. Stay informed for the next opportunity. Here's to capitalizing on March and driving sustained portfolio growth.